This is the P/E ratio of 3 different companies. But how do you know which numbers are good, which numbers are bad, and what are these numbers telling us? In this video, you're gonna learn everything you need to know about the P/E ratio, including how it can be applied to the entire stock market. The P/E ratio formula is simple. All you have to do is take the company's share price and divide it by the earnings per share of the company. To calculate the P/E ratio, you're gonna need to get the income statement, and you're also gonna need to get the price of the particular stock. You can do that by going online and finding the information, or using a tool like Y-Sheets. You can just simply enter the company name or the ticker, and you're gonna be able to get all the information you need, just like this. For Apple in 2023, we can see that the EPS was 6.16. The market cap was around 2.7 trillion. So if we take this number and then divide it by the number of shares outstanding that the company had at this particular time, we can see that the price per share would be 171.21. If you divide 171.21 divided by 6, we roughly get 27.79. This means that we're paying 27.79 times the earnings of the company. Now, generally, a lower P/E ratio is considered to be a good thing, whereas a higher P/E ratio is considered to be a bad thing. But how do you know what is the ideal P/E ratio to pay? One way to find out is to look at the P/E ratio historically. So in this case, we already have this calculation set up. We can just drag it across to get these numbers for different years in the past, and then with that we can just drag this formula across as well so that we can get the P/E ratio for different years. And what we can then do is compare how the current P/E ratio is different than the past P/E ratios. If right now, for example, it seems like the P/E ratio is much higher than the ones in the past, this perhaps means that it may not be the best time to invest in Apple stock at this particular stock price. Another way of analyzing the P/E ratio, which is very effective, is to take the company that we're analyzing and comparing that company with similar companies in similar industries that have similar market cap or that are competitive products or services. So in this case, we have a whole bunch of other competitors that are also public companies right here. And what we're gonna do is get the P/E ratio for all these companies. Now, as you saw from before, we calculated the P/E ratio annually, but the best way to compare companies by getting the latest stock price and then taking the earnings per share for the last 12 months. What you can do is, using the Y-Sheets add-on, you can apply this formula where you select the companies. We also want to select the P/E ratio, and we want this on what we call a TTM basis, the latest, which is the trailing 12 months. Select this formula, click enter, and as you can see, we're gonna get the P/E ratio for all these companies at once. From here, we can apply any calculations, such as comparing the average of all these companies with each of the individual P/E ratios, or what we can also do is to plot a chart of this data. So this type of chart would be very valuable to be able to visualize the information. And as we can see, out of the competitors, Nvidia has the highest P/E ratio, and then Apple is also one of the highest, but not the highest by any measure. So overall, comparing the P/E ratio of Apple with these other companies right here, as well as doing the historical P/E ratio analysis, we can see that at this moment, Apple's P/E ratio is a little bit high. Now, when it comes to using the P/E ratio to make investment decisions, there are several limitations that you need to be aware of. First, it doesn't take growth of the earnings into consideration. So for example, if you pay a pretty high P/E ratio, but if that company is growing its earnings really quickly, it may not matter how much of a price you're paying for that particular company, as long as the earnings make up for that. And this is where ratios like the PEG ratio come into place to adjust for that. The other factor is that the P/E ratio doesn't reflect the quality of a company, because oftentimes what happens is that companies that have a very low P/E ratio are very low quality companies. So it's not the best decision to invest in those companies, but instead invest in the companies that are high quality, likely to grow their earnings and their competitive position over time. And the last point is that this ratio doesn't include debt or cash flow. And these are two critical things, because if a company has too much debt, then it can go into bankruptcy. If a company runs out of cash cash flow, then it's not going to be able to finance its operations, and then it can also get into financial trouble. Now, the beauty about the P/E ratio is that this ratio can also be applied to the entire stock market or a particular stock market index like the S&P 500. So by having a list of those 500 companies and being able to calculate the P/E ratio for those, we could see what the P/E ratio would be for the entire stock market. As you can see, this is the S&P 500, and this has been the return of this index from the beginning over here all the way to where we're at now. This index essentially represents the stock performance of the 500 largest companies listed in the stock exchanges of the United States. And this is exactly what we can see right here, where in this graph we can see the P/E ratio of the entire S&P 500 at different periods of time, so that we could compare the P/E ratio right now, which is 28.37, with the historical numbers of the P/E ratio, and decide for ourselves whether or not at this particular price we want to invest in a market index like this one. Now you know everything about the P/E ratio. If you've enjoyed this video, make sure to subscribe to the channel, and I'll see you in the next one.